Welcome to The Explainer. Today, we're diving into a really fascinating idea. It's something that sits right at the intersection of ancient wealth and, cutting-edge technology. We're on a quest to create the perfect form of digital gold.
All right, so let's start with the basics. For thousands of years, gold has been the ultimate store of value. But let's be honest for a second. Physical gold has some serious drawbacks, right? I mean, it's heavy, it's a pain to store securely, and trying to trade a physical bar across the world, it's incredibly slow and just really complicated.
So that leads to a pretty obvious question. How do you trade gold without ever actually touching it? Well, the financial world came up with an answer for this decades ago. They called it paper gold. But as we're about to find out, that simple term hides a whole lot of complexity. And believe me, not all paper gold is created equal.
So what is paper gold? Well, basically, it's just a financial instrument that tracks the price of gold, but you don't have to own or store the physical metal yourself. It lets you get into the gold market with the ease of, say, trading a stock. But this convenience brings up a really crucial question. Do you actually own the gold, or do you just own an IOU from a bank?
And that question brings us to the single most important distinction you need to know about. You've got allocated gold versus unallocated gold. Now, with allocated gold, you have the legal title to a specific identifiable gold bar sitting in a vault with your name on it. But with unallocated gold, you're basically just an unsecured creditor. The bank owes you gold. And let me tell you, in a financial crisis, that difference is everything. One is your actual property, the other is just a promise.
Okay, so let's say you made the smart choice. You've got allocated gold. You're protected if the bank fails. Great. But is your gold actually easy to trade? You'd think so, right? Well, surprisingly, the answer is often nope.
Yeah, and this table really lays out the evolution here, and the trade-offs we've been making. I mean, we went from these slow, manual paper certificates to super liquid ETFs. That was a big step up. But they're still stuck in the old world. They only trade during traditional market hours. Now, modern digital tokens, they smash that barrier, offering 24/7 trading. But they introduce this brand new problem, one that keeps the really big players, the institutions, on the sidelines: regulatory uncertainty.
And this whole regulatory thing, it's actually part of a much bigger, multi-trillion-dollar problem that's holding back the tokenization of all sorts of assets. It's what we can call the institutional trust gap. So what's the deal? Why aren't the world's biggest financial firms just diving headfirst into this?
Well, it really boils down to three major roadblocks. First, the regulations are a total patchwork. For a global bank, that creates a level of legal risk they just can't stomach. Second, the technology itself, especially these really complex smart contract platforms, can feel like a black box to firms that demand absolute ironclad security. And maybe most importantly, they need a way to prove, without a single shadow of a doubt, that every single digital token is backed by a real audited bar of gold.
Okay, so that's the problem. And this is where a really powerful new model enters the picture. The idea is to solve this trust gap by combining the best of both worlds, the physical and the digital, on the most secure and trusted blockchain out there, Bitcoin.
So how would this actually work? Well, the model really rests on three key pillars. First, you start with Bitcoin's security. It's unmatched, it's battle-tested, it's immutable. Second, you need to operate inside a really clear regulatory framework. Something like the proposed Clarity Act, for example, would give institutions the legal certainty they're craving. And third, and this is the really clever part, you use protocol features to embed rich, verifiable data directly into the Bitcoin transaction itself.
So here's the crucial point. This is the big takeaway. The token isn't just a promise of gold. It's a digital title deed. Imagine this. A trusted refiner mints a token that's directly linked to a specific audited gold bar. All the key details, the serial number, the weight, the audit certificate, get recorded right there on the Bitcoin blockchain for everyone to see. And once that's done, that token can be traded instantly, 24/7, anywhere in the world, with the finality of a Bitcoin transaction.
Now, this all sounds pretty amazing, right? But it naturally leads to a really important and frankly, kind of scary question about the future of any digital asset.
And that question is, what if the digital world just fails? I mean, what if quantum computers suddenly break Bitcoin's encryption? This is the ultimate black swan event, right? The nightmare scenario for any digital system. If that happened, is everything just gone?
And the answer to that question is what makes this hybrid model so brilliant. See, unlike a purely digital asset whose value depends entirely on its network continuing to function, this token's value isn't just code. It's a legal claim on a real-world physical asset. Its ultimate worth comes from that hunk of gold sitting in a vault. Just think about what this quote is saying. The blockchain is a public, immutable ledger. So even if the Bitcoin network itself just stopped working forever, the historical record of every single transaction would still exist on thousands of computers all over the world. It is literally set in stone. And that permanent record? That's your proof of ownership.
What this creates is the ultimate physical backstop. Because your token is a legal claim and not just a line of code, the issuer is legally obligated to make you whole. So even in some kind of worst-case digital apocalypse, that historical blockchain record acts as your indestructible proof of ownership. You could literally use it to walk up to the vault and claim the actual physical gold bar that belongs to you.
And that brings us to the final, really mind-bending thought. This model, this combination of a trusted issuer, a physical asset, and an immutable public ledger, it isn't just about gold. Not at all. It could be the blueprint for tokenizing, well, everything. Real estate, fine art, private equity, you name it. It could fundamentally reshape the entire architecture of finance as we know it. So the real question is, what happens when every real-world asset becomes as liquid and as globally accessible as Bitcoin itself?